Over the last 3 years, the key dynamic for the apartment industry has been this. The increase in demand has outstripped the increase in supply. As a result, occupancy rates have risen even while rents nationally have outpaced the overall rate of inflation. That dynamic remains in place, making the apartment outlook for 2013 and beyond quite positive. New apartment construction has indeed rebounded sharply from its 2009 trough. But multifamily starts totaled only about 235,000 last year, well below the 300,000 level that prevailed in the decade from 1997 to 2006. So we still have a way to go just to fully recover. Actually, we probably need at least 300,000 new apartments each year. There are 4 big drivers: overall population increase, pent-up demand for housing, the continued, if gradual, improvement in the job market, and finally, the increased preference for renting. Let's break that down. We'll add close to 10 million more households over the rest of the decade, even if the growth rate is as slow as it was in the last decade. Close to 1 in 5 will be apartment renters. That's 2 million apartment renters in the next 8 years, or 250,000 more apartments occupied each year. But in addition, we lose somewhere between 50 and 100,000 apartments due to destruction or deterioration. That means we need 300,000 units or more annually. We might get 300,000 apartment starts this year. The run rate for multifamily permits ramped up close to that level in late 2012. But 2 caveats. First, NMHC's quarterly survey of apartment market conditions suggests that there are still constraints on construction finance outside the top-tier markets. And second, the increased demand we're seeing isn't only or even primarily for high-end units with high-end rents. Building new apartments that can make sense given the incomes of our prospective residents remains a challenge. Occupancy nationally sits at about 95%, solidly within the normal range. I wouldn't expect that to change much this year. Instead, I think any demand-supply imbalance will get passed through to rents, which should again rise a little faster than the overall price level. Even so, rents will probably rise at a slower rate than last year as we start to see more completed apartments come online. It's true that the for-sale housing market finally began to recover last year. But rather than a new boom, we're likely to see more of a gradual increase in both new construction and house prices. And while this may pull some people out of the apartment market, the improved fortunes of this sector should contribute towards faster economic growth and a better job market. Both of those things should help the apartment sector. There are 3 main reasons why I expect a gradual recovery for the homeownership market. Underwriting remains a lot closer to traditional norms, including substantial down payments, than to bubble-era standards. There is also a broader understanding that homeownership is not always and everywhere a great financial investment. And finally, more and more people have come to appreciate the benefits of renting. Even though the notion of owning a home still has a strong hold on many Americans, young people in particular see things a bit differently. Many are happy to rent rather than own their music, their bicycles, and their cars, and want the same flexibility in their housing. The homeownership rate has fallen by about 400 basis points from its peak. It's hard to see how it could fall by another 400 basis points anytime soon. Even though apartment renting has a lot going for it today, the fact is that the institutional support for homeownership remains strong. And by that I mean the preeminence of dispersed development patterns and models, anti-density attitudes, laws and regulations, financing constraints for mixed use, auto-based transit networks and funding, even inadequate design support for alternative development models. Making mixed-use, pedestrian-friendly, transit-oriented development a much larger part of the mix is going to take time and effort.